Okay, so what I'm going to do is go through a little history of the financial system in a few slides, then talk about the specifics of what happened in 2008, leading up to 2008, and then where we are currently. So the financial system we have now really only happened because Europe took over about 3 more continents and therefore was able to grow very fast for about a couple of centuries. And then we got fossil fuels, which allowed exponential growth. And to actually fund that exponential growth and allow the concentration of capital, we had to invent things like joint stock companies, which is the modern corporation, stock corporate bond markets, trade finance, fractional reserve banking. All of that got created because we were growing exponentially. Previously, pretty much nothing happened for decades or even centuries. Growth was minimal, so you didn't need all of this complex financial system to fund that kind of growth. And really, previously also, when you didn't have fossil fuels, you were limited by your biophysical resources, so you couldn't grow rapidly. At some point, you just hit a limit. There was only so much timber and arable land, etc., that you could have. Now, as soon as we put these things in place, we found something very interesting, that deregulated financial markets always crash. They just find different ways of crashing, and very strange ones. So in 1637, when Holland was the financial capital of the world, we had the Dutch tulip mania crash. And I mean tulips, flowers. So at one point, a tulip was worth as much as an expensive house in Amsterdam at the top of the crash. And people were just speculating on tulips. And very rapidly, what we find is higher prices drive people to buy. So the opposite of normal behavior, usually prices go up, people buy less. In financial markets, prices go up, people buy more. Prices go down, people sell. So it's usually the opposite behavior. It's a positive feedback loop that we've been all learning about, driven very hard within the financial markets. And prices crashed 90% plus within 6 months. This is normal behavior in a market crash. Normally it's 80 to 90% loss in value, very quickly. Then we had the 1711 South Sea bubble in the United Kingdom. If you like, this was a bit like the dot-com crash, where you had a company came up and said, I have this brilliant business idea. If it's successful, I'll make lots of money, and people all piled in and bought into it. Here what they said was, well, we've opened up the South Seas when we took over all these continents, so we've bought the right from the British government to go and find things in the South Seas. That was it. That was the prospectus of the company. People piled in. At one point, the shares are worth £1,000 each in 1711 money. Can you imagine how much that would be in today's money, £100,000, whatever. Once everybody bought in, and at some point they wondered what this was really worth, within 6 months those shares were worthless. Like 100% loss in value. Then in the 19th and early 20th centuries in the US, every 20 years you had the banking crash. So every 20 years, a number of banks would go bust. There was no deposit insurance, so the depositors would lose every single penny they had in the bank. You may know that TV program, the film they show usually every Christmas in the US called A Beautiful World. The guy's running the local bank and there's a run on the bank. That used to happen every 20 years, basically. And unlike the movie, there was no nice guy coming along to rescue the bank. Then it ended up the panic of 1907 and the crash of 1929, which we all know about, and the Great Depression of the 1930s. And actually, the crash of 29 was a bit like the dot-com bubble, because there's a lot of new technology coming through, electricity, cars, etc., radios, which is kind of the equivalent of the internet. So there's a huge technology bubble built up, and then you had the crash in 29. After that, the governments went in and said, how do we stop this happening? You had Keynesianism, and you also had a huge amount of regulation for the banks. So they basically put, if you like, they put the banks in a kind of insane asylum, strapped their arms together, whipped them into a padded cell and said that you're not allowed to get out of that cell. So during that period, from the 30s to the 70s, there were no financial crashes. And the economy grew very, very well. It was actually the fastest rate of expansion in many, many countries during that period. So it's a question of, do you really need deregulated financial markets to drive economic development? This would tend to argue not. Interestingly, in the 1970s, the average bond trader on Wall Street needed a second job to make ends meet. It was not a flashy job being in banking or finance, like the mid-70s. Yeah. It was only in the 80s when they suddenly became millionaires. So then from the 1970s onwards, we started to have deregulation again. A lot of it was because the United States was spending too much money on Vietnam, plus putting into place Social Security and pensions. So they walked away from fixed exchange rates and then started deregulating all of the financial markets again. And very rapidly, within a decade, we started having crashes again. So in 1982, we had a Latin America debt crisis, where a lot of the Latin American countries had problems paying off their debts. Importantly, they didn't default. In the 1930s, Latin America defaulted. Did much better than most of the countries. In this case, they didn't, and you had the lost decade, as they call it, in the 1980s in Latin America, where living standards fell because they were basically driving the pain into the population. The creditors didn't feel any pain in that process. Then you had the 1980s US savings and loan crisis. These were mortgage banks. So your local mortgage banks lending to actually buy houses. There was a massive amount of fraud and theft. None of it was punished. But the US government closed down about half of the savings and loans organizations in the US at a cost of, I think, about $500 billion. Then you had the 1987 stock market crash, where the US stock market fell 25% in a day, driven really by futures and options, that people thought they'd hedged themselves, but when they actually went in to get the hedges, they drove more selling. It built on itself, and you had a huge market crash. Stock market was frozen for a little while, and then the government came in and basically helped bail it out at that point. Then you had the 90s Japanese financial crash, where the Nikkei went down. The Nikkei is the Japanese stock market, fell 80%. They've had 2 lost decades as they've tried to recover from that as well. Then in 97, you had the Asian financial crisis, where lots of hot money had gone into these countries because they're expanding rapidly. Interest rates started to rise. They all rushed for the doors and crashed South Korea, Taiwan, many of those countries. What happened was the IMF came in and forced those countries to restructure and open up their markets to foreign competition whilst rescuing them. The only country that survived pretty well was Malaysia, because they put in controls and forced controls on the actual free market. So they went against neoclassical teachings and went, no, we're the government, we can actually manage our economy. And they actually lasted very well through it, did not have to restructure their economy. Then you have the 98 Russian financial crash, same thing. And you also had this wonderful organization called Long-Term Capital Management. This had a number of the best PhDs in finance actually running the company. There's actually the way you price options is called Black and Scholes. Those are the 2 guys who invented it. They worked for this company. And they had financial models which they thought they could manage any financial risk at all. But when the Russian financial crisis happened, the markets went illiquid, and all the things that they thought they could buy and sell, they couldn't. And they'd leveraged themselves massively. So this one company could take down the global financial system. So the Federal Reserve had to come in, get a bunch of Wall Street banks together, and basically rescue long-term capital management. Otherwise, we would have been in a depression due to one company, one hedge fund, because it was massively leveraged. And then you have the dot-com bubble crash, which is basically the technology crash in 2000. So a pattern we see is that the financial institutions were always bailed out. Fraud was not punished. CEOs were not removed who'd driven this kind of risk. Debtors were made to pay, not creditors. Interest rates were always reduced and more credit thrown in to try and rescue the economy. And regulatory forgiveness, basically the banks were allowed to lie about the value of their securities so they didn't appear insolvent. So what happened, if you think about Schumpeterian kind of creative destruction, the creative destruction was never allowed to happen. It's like an ecosystem where you never allow the fire to go through and clear out the ecosystem. So all the players were still there. In addition, they started thinking the market could never crash because it always got rescued. So they started to forget about risk and say, well, I'll just socialize losses because they'll always come in and rescue me. So that more and more risk blowing up more and more bubbles as we went forward. And we had this wonderful term called the Greenspan put. Greenspan was the Federal Reserve Governor of the USA. And they basically said Greenspan provided a put option which protects you against falling prices for all of the market players because he always came in and rescued the market. And there's a saying that in financial markets, at some point you have to take away the punch bowl. It's like being at a party and you have a bunch of teenagers and they just drunk all the punch. And you're supposed to take it away before they get completely wasted. If you like, what Greenspan did is came in and poured vodka in the punch bowl and let them keep going. And the next time he poured even more in the punch bowl, and he just got more and more reckless, and the bubbles got bigger and bigger as you went along. In addition, we had proof, if you think about phenomenologically wise, we had physical proof every time that deregulation wasn't working because we kept having crashes. But the government and the neoclassical economists kept saying, no, you should deregulate. It's a really good thing. You have to deregulate the financial markets. One of the interesting things was there was a revolving door between the regulators and the treasury departments and the banks. It's a very interesting case of a guy who became head of Citibank. Just before he did that, he was involved in legislation which allowed commercial investment banks to merge again, called Glass-Steagall being removed. He then went to work for Citigroup, which was the merger of a commercial investment bank, and was very well paid as the CEO of that bank. That's just one example. There's many, many examples of that. So that's perhaps one reason why they weren't listening to the actual proof, making too much money out of this process. Now, another important part is, how is money actually created? So a lot of people tend to think, it's grandma goes in and puts some money on deposit, and then the bank takes her money and lends it to some company, and then it comes back again. In fact, money is created from nothing, out of thin air. So when you go in a bank and get a loan, the bank computer system creates one amount called the loan, and it creates another amount called the deposit, and that's it, and money is created. But it's creating debt as part of the money. And then when you come back, you pay the debt off, and the bank gets to keep the interest for creating something out of nothing. And it's really been a huge change, because historically the creation of money has been the right of the sovereign. The king or queen, they minted coins, etc. This is really passed over now to the commercial banks. And there's really no control over how much money they can create. And up to 73, money was linked to gold. So you would get your $5 note, and it would say at the bottom, you could go to the Federal Reserve and say, give me $5 worth of gold. After 1973, that was completely delinked. So it's just a piece of paper. And you trust that people will honor it. And now those pieces of paper are only 3% of money. Everything else is credit cards, checking accounts, debit cards, everything else. And that's all in commercial banks. So I'll just play this for you to explain that.
Banks are the most heavily subsidized businesses in the world, specially protected by governments. While the money runs out for the rest of us, the largest private banks still thrive. This is because they get the biggest subsidy of them all.
The license to print money.
Hard to believe? Martin Wolf, the chief economics editor of the Financial Times, said it recently. The essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. You heard that right. Private banks create money out of nothing. Then they loan it to us and ask for interest on top. If you've ever wondered why the bank buildings around the world soar higher than any palace or spire ever did, you now have the answer. But the banks don't simply print money using secret printing presses in their basements. They don't have to. Like so many other things these days, printing money has now gone digital. With the popular use of debit cards, electronic fund transfers and internet banking, only 3% of the money in the UK is now made of paper and metal coin. The other 97% is entirely in computers. Electronic money is convenient for everyone, but it's especially convenient for the private banks, since they own, run and control the entire digital money system. And what do they do with this special privilege? Do they channel new money, the blood supply of the nation, towards the things we need, like hospitals, schools, universities and public transport? Not if it doesn't make a profit for them. Instead, they use their license to print money to gamble on the financial markets and push house prices out of reach of ordinary people by pumping hundreds of billions of pounds into risky mortgages. This is exactly how the banks caused the financial crisis. And now the rest of us are being asked to pay for it. If we can't afford to run hospitals and build schools, can we really afford to subsidize the financial industry? Should we have to live with less so the bankers can have more? This is ludicrous, and it's time to put a stop to it. The private banks can't be trusted to hold the reins to our entire economy. We need to take away the bank's power to create money out of nothing. This will stop them from causing yet another financial meltdown, and allow us to afford the crucial services that we as a society need.
So you think in 2000 we had the dot-com bubble crash. If we'd gone the way of 1929, we would have had a major depression. We would have flushed out at last all of the bad decisions that have been done in the past 25 years. Many of the big banks, including Citigroup, that got rescued once every 10 years, would not exist any longer. But that didn't happen. Once again, the government went in and said, we cannot allow the financial markets to crash. We have to rescue them. We have to do whatever we can possibly do. So first of all, they lowered interest rates very low. That makes borrowers borrow more money because people tend to focus on the payments, not the principal. How much do I have to pay each month? Well, if you reduce interest rates very, very low, then people suddenly take massive mortgages out. In addition, there was regulatory laxity with respect to the mortgage industry. So the mortgage industry was allowed to do stuff they wouldn't normally be allowed to do. Also, the whole derivatives market was deregulated, so the banks could go make extremely complex derivative structures and lend them to groups which really didn't understand them. So suddenly you had local pension funds, even local authorities in countries taking on interest rate swaps and derivatives they didn't understand, but usually cost them much more money than they actually thought they would happen. So they're missold. You also had derivatives used to hide short-term problems. For instance, Goldman Sachs did swaps with Greece, which misstated their level of indebtedness so they could get into the single European currency. So they got that down. It appeared they had less debt than they actually had. Then you still, even after the long-term capital management problem, we still had this belief that complex financial models could tell us exactly how the financial markets would work, and therefore we could perfectly hedge ourselves. So you had these called value at risk models everybody was relying on, saying, well, I can only lose $25 a day because my value at risk model tells me that's the way it can be. What turned out is they were completely wrong. Again, the models were just a model. They were not reality, as we've kind of seen in many of the teachings we've had in the past few days. And then also the leverage ratios of the major banks expanded. They took on more and more debt versus the assets that they had. There was continued deregulation. So in 1999, Glass-Steagall was repealed in the US. So the banks that produce money, the commercial banks, could actually merge with the banks that took risk in the financial markets, which had not been the case for over 60 years. So that was done. So you had Citigroup and many, many banks then merged together. In addition, what was happening in Europe, was which made things worse, is you had the European single currency. So you had countries like Spain, Italy, Greece, all have a history of defaulting regularly on government debt, on other debts. But with the European single currency, one, you have no exchange rate risk, it's all in euros, and everybody assumed that there was no default risk. Doesn't seem logical now looking back, but that's what they assumed. So suddenly the Spanish could lend money, borrow money at the same rate, interest rate as the Germans, and the Greeks and the Italians, etc. So of course they rushed in and borrowed a lot of money at those rates, which were much lower than they previously had, and you had asset bubbles actually growing within those countries. So it kind of very greatly exacerbated the issue. Ireland was the same as well. For a few years you had the Irish miracle where instead of emigration from Ireland, you had immigration into Ireland because things were growing so fast and house prices were trebling and quadrupling. Now, second issue is the way in which mortgages were being distributed and originated changed. So historically, you go to a bank, you sit down, you get a mortgage, and you agree, and that mortgage, that liability stays with the bank you talk to. That's what you assume. So they're going to manage you because they're going to be with you for 25, 35 years that you're paying off that mortgage. And they're going to worry about, will you default? How much money do you earn? Are you in a kind of industry where you'll still be employed 20, 25 years from now? Are you the kind of person they should lend money to? What's your previous credit rating? All of those things. They worried about that. But in the US and somewhat also in the UK, they came up with a different model. So the first part on the left-hand side is as it used to be. Buyers would come in, I want to buy a house, I'll sign a mortgage agreement to pay you interest and principal, and you give me the money to buy the house. But now, the first organization would then bundle up those mortgages and sell them to a packager and distributor investment bank. And they would put them in things called mortgage-backed securities. So they'll take 100 mortgages, 1,000 mortgages, put them into one, put all the payments together, and then say, so you investor can now come and buy this, and you have the right to all the principal payments and all the interest payments. So the packaging distributor did that, then they sold those instruments around the world. You had the basic mortgage-backed securities, and then you had things called collateralized debt obligations, which is basically extremely leveraged versions of mortgage-backed securities with a lot of debt involved to ramp up the actual returns. Now, the investors went, these are highly complex instruments. I don't know how to value this. I don't know how risky it is. So they went to another party called the rating agencies, like Moody's, and said, please tell me how risky this security is. So the rating agencies came along, and generally they gave them what's called AAA ratings, the best possible ratings. Possibility of default is minimal, therefore you should pay top dollar and you're nice and safe. The problem was the investors weren't paying the rating agencies, the people doing the packaging was paying the rating agencies. So the conflict of interest was in the interest of the rating agencies to keep those banks selling those packages happy. So the dollars went one way and the ratings went another. And if you look backwards, now again, always in hindsight with these things, the fact that anybody would think a bunch of crappy mortgages in many cases which should have a AAA rating was crazy. But that's what happened. Now, at the front end of this process and even the middle, you have a difference in incentives. They don't worry about the credit risk, they're dumping that off to the investors. So all they care about is throughput. As they care about throughput, they don't care about credit quality. Now they just want to keep lending to anybody they can find to lend to. Because the way they make money is off a margin before they pass it on. Right? So it's a big kind of game of pass the parcel. Who's going to end up with the hot thing with the credit risk when the music stops? And they just kept going round and round and round, faster and faster. So what you ended up with a very dangerous mortgage lending. And you get more and more and more dangerous. So the first thing that started was you're allowed a mortgage in a higher multiple of your income. So instead of 2.5 times income, it was 4 times income. It was 4 times your joint income. It was 5 times income. Also, you could amortize over a longer period. So instead of 25 years, it was 40 years. Then we got into interest-only mortgages. So, and you can tell people are getting desperate now. I can't find anybody for a normal mortgage. Let's sell them something else so we can still get them into a mortgage. So they said for the first few years, you only pay the interest. You don't pay the principal. And then after a few years, it resets into a normal mortgage. Now, at this point, house prices were going up so much, people assumed, well, it'll reset if I have a problem, I'll just sell the house because it'll be worth 50% more. That's really the assumption in a lot of this lending. Then you had options adjustable rate mortgages. This is where you decided, maybe I don't want to pay all the interest. So if the interest rate on the mortgage is 6%, I'll only pay 3%, and they'll take the 3% and add it to the principal. So your principal actually grows. And then when you reset after 5 or 10 years into a normal mortgage, suddenly your mortgage payments may double or treble. Again, it gets people in early on with low payments, and all they're looking at is the monthly payments. Then you had, especially in the US, called no-doc mortgages. This was done really for self-employed people who couldn't come along with a pay slip and document their income, which is a very small niche. This became a major part of the mortgage market. Why? So you could lie about your income. And there's many, many times seen now people fraudulently lied about their income. You walk in, so instead of walking to a bank and they go, oh, well, we have to be really careful about how much money you make and how sure your employment is, they're sitting there going, so you're a gardener and the house is worth this much, so you need $200,000 income to buy this house, don't you? You're a really good gardener, aren't you? You make $200,000. Please nod your head and sign at the bottom. Here's your loan. And that's what happens. So a large amount of these loans are directly fraudulent. Then you had subprime. So this is going down to finding riskier and riskier people. People who defaulted on car loans before, defaulted on other things before, getting them into these loans. Now you'd think you couldn't sell these loans to investors because they're highly risky. But the rating agencies kept talking about, oh, we have financial theory which says if you have many, many of these loans, then they can't all default at the same time. So the overall risk of the portfolio is lower than the individual loans. The assumption is that not all of the US housing market would go down in price at the same time because it had never happened before. An assumption that wasn't a good one. Then we have the last one, which is beautiful, called ninja loans. And it's hard to believe in hindsight. You have the ninja loan is no income, no job, no assets, but you got a loan. That's how far they're going down the bottom of the barrel, just trying to get people to shove through this process so they can make a huge amount of money and dump the credit risk on the investors. That's basically what happens. And the regulators are sitting there watching all of this happen. But you have to remember the regulators and the governments were desperate to keep the economy growing. Because there were severe difficulties in 2001 and 2002, even at one point General Motors, people had difficulty selling their short-term debt in the markets. So we're driving this process. By about 2006, 2007, the regulators and the central banks started pulling back and raising interest rates a little bit. But trying to reduce a bubble slowly is usually impossible. At some point, it just implodes of its own accord if you try to do that. Now, if you look at the expansion in debt, so on the left-hand side is what happens in the 1930s. That's the Great Depression. But even in the 1930s, the bank assets as a percent of GDP were less than 100%. In the 2008, it had already gone up to twice GDP. So it's a much bigger bubble than in 1929. But this is the end result of 25, 30 years of bailing out the financial system. With all this going on, you're funneling tons of credit into buying houses. Guess what? House prices go rapidly up. People start assuming that house prices will go rapidly up all the time, and therefore they tend to buy more houses and take out bigger loans because they assume no risk. So you can see from 1900 to 1950, not much, little bump, some rise to the 70s to the 90s as deregulation came in, but then you have the huge leap towards the end of the 90s, nearly vertically upwards all the way to 2007. So this is US housing prices. Same in the UK, same leap up in the last few years. Then you have it in Ireland and Spain as well. So you have many, many countries exactly the same thing happening. Huge amounts of debt being created to drive house prices. Another thing that was happening, though, was that crude oil prices were increasing from about $20 at the beginning of the 2000s all the way up to, I think, the top was about $146. Now, the impact of this is like a tax on people because they have to pay more for oil. So it reduces income they can spend on other things. So it tends to be recessionary. So you think you've got the central banks starting to raise interest rates a little bit, then you've got oil prices going up, pulling on income, would have caused a mild recession. But you've got this hugely problematic financial sector based on a huge amount of faulty debt, now rapidly accelerates those problems. So the first kind of rumbling started in 2007. You had basically some of the companies involved started to go bust because house prices weren't increasing anymore. Suddenly they couldn't flow through all of these mortgages and they started to go bust. Also, Freddie Mac, which is a US government organization supporting the mortgage market, started to get worried and started to stop supporting the riskiest mortgages. So already in 2007, if anybody was looking, you could have guessed that there were big problems. And the worst was British Northern Rock, which is a big bank in Britain, was unable to sell its mortgages onwards and started to be shopped around by the British government to be sold. And 2008 started getting worse, but the pattern previously was still being done. So the government would go in different countries, they'd find some company in distress, then they go to another bank and say, can you buy this bank? And we'll lend you lots of money and help you along. So you had Bank of America bought Countrywide Financial, which really to rescue in January. The British government couldn't do that with Northern Rock, so they actually nationalized them. JP Morgan bought Bear Stearns. The US government bailed out Fannie Mae, Freddie Mac, and then Bank of America buys Merrill Lynch. Up to that point, it's all working. We've got a huge bubble, but it's not crashing. The government is still going in and rescuing things, and the old game plan is there, just spending more money than they used to. The big mistake was with Lehman Brothers. So with Lehman Brothers, they actually let Lehman Brothers fail. So you think this is after 3 decades of pretty much telling the financial markets, we will always bail you out. We will never let a major counterparty fail. They let Lehman Brothers fail over the weekend. This sent a shock through the whole of the financial market. All the counterparties involved suddenly started worrying that somebody else could fail. So you had a huge bank run across the whole financial market as people pulled in money from other banks. Because nobody knew who was risky and who wasn't. They were just panicking on the Monday saying, we've got to protect ourselves. The problem is it's so interconnected. So instead of those dotted interconnection lines, it was all hard interconnection lines. The whole thing started imploding because it just started rolling around as a positive process, accelerating on. And that was really the panic during that week as everybody started pulling their money out. One of the big areas of money market funds, which have a lot of bank debt inside them, people started pulling their money out of money market funds, and they had to freeze some of the money market funds, which people assume was pretty close to cash. AIG was the insurer of so many different companies, so they'd taken a lot of riskiness. Another thing they thought was, well, I can just buy insurance. So I have risk against Lehman Brothers, but if Lehman goes bankrupt, I'll just go to my insurer and pull my insurance contract. But this is like, you know, you've insured every house in America with one insurance company that doesn't have a lot of money. And AIG had insured way, way more than they could ever pay out. So as soon as Lehman Brothers went down, it was a real failure. Suddenly people started pulling in their insurance. AIG went down within days. Now what the US government did then is panic immediately and say, well, we can't let anybody else go down because otherwise the whole financial market will just go down with it. So they rescued AIG. And in a normal bankruptcy, the AIG contracts maybe paid out 5 cents on the dollar. They paid out 100 cents on the dollar, not to all of the counterparties insured by AIG. One of those counterparties was a company called Goldman Sachs. So Goldman Sachs was paid $13 billion by AIG on the insurance contracts when they would have probably got pennies on the dollar. Before that payout, Goldman Sachs was looking at going completely bankrupt and wiping out the company. But it wasn't just to Goldman Sachs. Many different banks in the globe. The bank I worked for, Bank of Montreal, got basically $1 billion from the US taxpayer on its insurance. So once they bailed out AIG, they went into a massive bailout process. Some of it was they tried to keep secret of who they lent the money to. There's actually, Bloomberg had to go in and sue the US government for the right to know what the Federal Reserve had done. And it turned out just the Federal Reserve spent about $17 trillion to bail out the financial system in 2008, 2009. So if you think the US economy at the time was about $14 trillion, so they spent more than the worth of the whole US economy in about a 1-year period. And that was just the US authorities. In addition to that, there was, you know, the Bank of England came in and bought Royal Bank of Scotland again and again, all the way through to rescue the financial system. So again, the bubble had grown so huge, you're now into massive amounts of money to rescue the system. In addition, they dropped interest rates down to pretty close to zero, because it's the furthest they could drop them down to reduce the amount of interest people had to pay on loans. So you go through this whole process, banks are nationalized, banks are bailed out, huge amounts of liquidity is put into the marketplace. Then you have quantitative easing after that, which is basically monetizing US government debt and mortgage-backed securities. A chunk of this was also the US Federal Reserve taking the riskiest, worst assets off the banks into its own portfolios. Again, this was not advertised, but basically the US taxpayer took the crappiest assets from the banks, gave them 100 cents on the dollar, and took all the risks. The future US taxpayer will pay that. So we're now in 2014. Has anything really changed? No. So the financial system is still on life support. You still have quantitative easing every month. They're not talking about getting rid of quantitative easing. They're talking about maybe reducing it a little bit. And people are even worried about that. You've still got direct market actions by the banks and by the central banks. In Japan, the central bank is explicitly stating it is buying shares in the open market to support the stock market. You've still got regulatory lenience. Many of the assets of many of the banks are worth much less than they're actually stating. So they can say they're not insolvent. And you've got what was a zero interest rate policy, ZIRP as they call it, and now talk about negative interest rate policy. Because they can't go any further down, but things still aren't recovering, so now maybe they go negative interest rates. Which is interesting from a steady state economy point of view, because they talk about demurrage and negative interest rates. From an ecological point of view, here it's just to rescue the financial system. They've also had one bank rescue in Crete, where the banks went bust, financial crisis, where they took the depositors' money to bail out the bank. So you have $100 on deposit, they took $10 of it and said, we have to take 10 of your dollars to rescue the bank, so now you only have $90. What's interesting right now is many countries are passing laws, not advertising the fact, to allow them to do this as well, like Canada and the US and other countries. So maybe soon coming to you. They call it a nice word, it's called a bail-in. You've been bailed in, i.e. they stole some of your money to bail the bank out. Debt levels are still increasing. There's been no debt forgiveness or default. Normally, if you look historically, the way these things were dealt with, there's default. You defaulted on the debt was flushed out, the banks went bust, assets were reduced in value, and then things could clear out and actually move on. Classic Schumpeterian creative destruction. We have slow or no growth, especially in Europe and Japan, and they keep kicking the can down the road, as we call it. They keep lending more money and bailouts not to deal with the underlying problem. You saw that in Greece when they just extended all the loans. I mean, the European Central Bank now, I think, is the biggest creditor of Greece. Also, because the risk takers haven't been removed. So Citibank's still there after being bailed out at least once every decade. Goldman Sachs is still there. Morgan Stanley is still there. The players are still there. They're taking more and more risk. The markets right now is the same kind of frothiness. You've still got, things like Tesla shares going up 10, 20 times in less than a year. You're nearly back in the dot-com bubble where we've got technology shares with no income being valued at billions of dollars. 16-year-olds becoming billionaires for the little apps they made. All of that is back in vogue. So we look at the debt levels. These are the debt levels in the US. This is total debt. Never went down. So you see the huge run up from 75. And all we did really was to exchange a little bit of financial debt for government debt. But overall debt levels are still increasing. So at no point is what should happen, which debt levels decrease by default, flush that out of the system and allow the economy to start growing properly again. This is why the governments cannot increase interest rates. You increase interest rates on this amount of debt, you immediately drive the economy into recession again. Same in the UK, this is UK government debt, massively went up. Part of that was rescuing the banks. The irony now is the same banks are arguing that, of course, we have to cut costs, etc., because the governments have so much debt, which is caused by having to bail the banks out. It's interesting how we can manage the message so well. So what next? You can't bet against just continuing to muddle through. Japan's been doing it for 20 years. They'll just create more money, bail this out, bail that out. They could keep muddling through for a very long time. They have the right to create money. There may be eventual crisis in some countries, especially with declining populations, but that's like a decade or two off. Financial system could simply crash by itself. With something this fragile, you get something rolling, it will just, positive feedback loops kick in and suddenly you have a crash. The question is, will this ever be allowed to happen? Or will the governments once again go in and be able to rescue it? There's been the question of, will the problem be so big they can't rescue it? But people have been betting that for the last 20 years, and they still seem to be able to do it. Maybe it'll be $100 trillion next time. Who knows? The other possibility is an external event drives it. You have a recession, you have a war, you have energy constraints. What happens if climate change comes in? We want to go to a steady state economy with this, the markets will crash. But really, we have not moved out of the emergency room for the financial markets. I mean, one good metaphor is you have an individual who was working on a farm and he had his leg ripped off by the machinery. They pull him in, his leg destroyed, they pull him into the hospital. Instead of taking his leg off and stopping the bleeding, they just keep pouring blood into him. That's basically what the central banks and the governments are doing in the financial markets right now.